Hey, I've got a question for you. Are you harnessing the power of accounting to get paid what you are worth? This is for electrical business owners. And of course, as always, the performer generates the results. So, um, us as business owners, we have certain ideas when we go into business of what it's going to be like, how much we're going to be able to earn, and all of that kind of stuff. And sometimes it turns out like we thought and what we had hoped, and but a lot of times it's a bit of a winding road. And so, the purpose of me putting this together for you today is to evaluate, are you getting paid what you're worth? And could changes to accounting and a focus on improving the data that you're getting as the business owner make your business enable your business to pay you what you're truly worth. So let's get to it. My name is Johnny with Barrett Consulting, and we serve electrical contractors with accounting services. All right, so let's start here. Why is accounting even necessary? Well, all of this is going to be pretty obvious to you, but let's just go over this. So, accounting has been around forever, and it is essential for business. And not only for business, I would say, is accounting is essential for personal finances. Accounting is essential for government. You know, pretty much every entity, every person, and every entity needs accounting. Accounting is a $147 billion industry in the US. And what does it do? So, proper accounting enables businesses to succeed, and proper accounting reduces risk. So, it reduces the risk of fraud, of business failure, and things that we don't want. All right, so to frame this conversation, um, I'm going to talk about balance sheet accounting and what balance sheet accounting is, because again, I want to talk about, are you getting paid what you're worth? And balance sheet accounting is something that can help you with that. So I have a friend named Dan, a very successful um, contractor. He actually does works in stone. He does like stone cladding for commercial buildings, tile, countertops, anything to do with that kind of stuff. And so he does residential, but he has a company that does commercial. And I've known him for for many years now, and we've, as a business owner, him and I, and since I'm an accountant, a lot of times our conversations turn to accounting. And this was quite a few years ago. We were talking, and he brought up something he said was balance sheet accounting. And at the time, I hadn't worked with tons of business owners myself. I was working as an entry level accountant. And so I was like, okay, balance sheet accounting. I know what a balance sheet is and stuff, but you know, as a business owner, obviously he values balance sheet accounting. What is it? And so I do want to talk about balance sheet accounting today. I think for him, once his business grew to a certain point, there was a light bulb moment for him where him and his partners started investing more into the accounting, kind of stepping beyond just basic bookkeeping and really doing what he called balance sheet accounting. So we'll get into that. And you know, fast forward to now, I was just actually having a client meeting the other day, and at the end of the call, when we had gone through the finances and everything, I asked him a question about the billing, and you know, our conversation just kept going. And then he said, "Well, you're worth every penny, that's for sure." And so that warmed my heart. But I think um, what really makes him feel like he values what I've been doing for him and for his company is along the same topic of balance sheet accounting. And so let's see, I did want to talk about so just one example before we really dive into this is with my own business, unearned revenue. So um, I had a client come aboard recently where you know there was a payment up front for you know a cleanup project, catch up on previous you know months of bookkeeping and accounting, and so when I recorded that, rather than just record that as revenue in that month, because I knew not all of the work would be done in that month, I was able to record a portion of that income over into the balance sheet as unearned revenue, which is a liability because my client had paid me, but it's work that hadn't been done yet. So I put it on in the accounting as an unearned revenue, a liability, and then over time, as my team and I satisfied um, what that payment was for and got the work done, then we were able to move that from unearned revenue and record it as revenue to show up on the income statement. So that's just a quick example of balance sheet accounting. Balance sheet accounting allocates expense and revenue to their correct period. So if work was done and we earned $10,000, but we don't record the expenses because we're waiting to pay the supply house and we're not going to pay them for 2 months, then we're really not matching up the revenue because we have the invoice. We're going to show the revenue on our income statement, but then on the income statement, we're not going to see the expense until 2 months down the road when we actually pay the bill to the supply house. So with balance sheet accounting, we want to allocate the expenses and revenue in the correct period. Okay, so with balance sheet accounting, let's talk a little bit about current assets and liabilities. I have a list here. So we have, a balance where assets are on one side and liabilities are on another side. Um, Examples of current assets would be cash, like any bank balances, accounts receivable. So this is where work has been done, an invoice is generated. Um, the project is complete and we're just waiting for payment. So it's not cash, but we expect that it will be converted into cash. Okay, and then on this other side, we have inventory. That's where we used cash to purchase inventory, which is an asset that we haven't used yet. Okay, liabilities, pretty straightforward. Credit card balance, so we've already made incurred charges, but we haven't paid for them yet because we owe it. Currently, it's basically in essence a short-term loan from the credit card company. Um, and lastly, we have accounts payable on the liability side. So accounts payable, that would be where, hey, we purchased this material from the supply house, went out, did the job, installed those materials into the job, but we haven't paid the supplier yet. Those are accounts payable. Okay, so as you can see, we have this equation where things are more or less balancing, and once um, and so these things are interlinked with the income statement. And so if we are correct on all these things, if our cash balances reflect correctly, let's say at the end of the month, our accounts receivable is right, meaning that we've created invoices for all of our customers, and we haven't created invoices for work that hasn't been done yet, or we've made adjustments for that. We have a correct counting of our inventory, if that's applicable. We have our correct credit card balance as of the end of the month, and we've entered any, supplier bills or things that we owe. Then we're going to have everything in its right place, and that translates into our profit and loss statement actually being correct information that we can rely on. Okay, so what are best practices? So I just wrote out a couple things here. It's definitely not comprehensive, but a few things that, I see when I'm looking at people's accounting records for, electrical contractors, that you might want to spot check on your business whether your processes are accounting for this or not. So first one, invoice the portion of work that's complete in the appropriate period or make an accounting adjustment. So let's say you did a giant commercial job and you've completed, let's say, 50% of the work. You've sent out an invoice for it. You completed that work this month, in the month of October, then you'd want that invoice to have the date of October, sometime in October, so that when you're looking at your income statement, it's going to show up there. Now, what you don't want to do is if you've done 50% of the work, you don't want to have an invoice for the full amount in the month of October. And us accountants, we can make an adjustment for that if needed, or we could do progress billing so that we're only going to bill the 50%, and then whenever the rest of the next portion of the work, then we can bill that in the correct month, and so on. So that's something to watch for, because if we do this incorrectly, then our income statement is going to be inflated because we're going to say we did 100% of the work when it's not complete yet. 100%, and correspondingly we'll have an accounts receivable. Um, our accounts receivable will show higher also than what is accurate. Okay, so and this I already kind of talked about this. So using the invoice date as of when the work is completed. So again, we don't want to be invoicing something in a previous period, like some 2 months ago, if the work actually wasn't done until now. Now, the next part, this is along the lines of accounts payable or, bills due to supplier. So record bills with their correct bill dates and mark those paid when paid. By doing those things, one, we'll get the expense into the correct period on the income statement, but then we'll also, as of the end of the month, excuse me, we'll always show that the accounts payable balance, like what we owe our suppliers, is accurate. And then record any unused materials to inventory. So if we have an accounts payable, so we paid the supplier for something, say it's $100 part, and it wasn't used, it's probably not that big of a deal, so we can just expense that. However, if we've paid the supplier for $100,000 worth of material, it's sitting in our shop in inventory that we're going to use later. Well, our profit and loss is going to show that, hey, we spent $100,000 worth. We spent $100,000 on what is inventory, but we're not recording it as inventory. We've already recorded it as an expense. And so, if it's a tiny amount, that's fine. Just expense it. If you have a ongoing inventory that's pretty sizable, then you want to have it recorded as such so that your assets are showing properly. Okay, so there's just a few, again, this isn't comprehensive, but just a few best practices for you to think about, for you to look at your processes and see, compare and see what you're doing and whether you can improve your financial reporting. Okay, so all that, what are the benefits of actually doing that? Change is costly. It takes time. It takes effort, investment, maybe even of money or time or whatever. So why would you even do that? So what are the benefits to you? One is that you get an accurate income statement. If you are looking at an income statement and you see, hey, I earned $100,000 for this commercial job, but then the expense isn't recorded because you don't pay your supply house for a month or two, then you're going to show an inflated profit, an inflated net income on that month, and then a month or two down the line when you actually pay the supply house, you'll show a giant expense for all the materials that you finally paid for that. And so you're going to get a lumpy income statement where it's just the information isn't useful to you because you're seeing basically a roller coaster of ups and downs, and the expenses and the revenue aren't matched in the correct period. So by doing these best practices that I mentioned, then you're going to have an accurate income statement matching expenses to revenue, and then you'll have accurate balance sheet positions as well. So over time, you can monitor your assets compared to your liabilities. You can monitor those trends and even establish KPIs or ratios to make sure things are in check. Because if you have a good handle on not only your income statement, how things are doing, how profitable you're being, but also you're managing your cash flow with your accounts payable. You're managing your inventory tightly. You're making sure that we're converting accounts receivable balances into actually cash in the bank. as you can see, it really puts you in the driver's seat when you have a clear view of all these different components. So accurate balance sheet positions and then true performance measures. And that's really what we want as the manager of the business, as the owner of the business. Um, the information needs to be timely and it needs to be accurate, and that just gives us a true performance measure, so that over time it affects our business decisions and can make us much more profitable. So all of that translates into reality-based decision making and controlled growth and profits. So I have a couple questions for you. Are you harnessing the power of accounting to control your growth and profitability? And is what you are doing working to help you achieve your goals? So again, going back to the kind of original slide there, I was talking about how we all go into business with, certain aspirations, certain goals. Um, so this is a way that we can really harness accounting to get us where we want to be. So I have this picture here of these draft horses and they're harnessed. So the power of accounting would be these horses. The accounting can really be powerful. It's one of the important operational pillars of a business. And if we harness the power of accounting, it can really pull us forward, because it empowers the owner or the manager of the business, to clearly see what is going on, and by seeing that, be able to make adjustments, whether it's pricing adjustments, um, and just all kinds of decisions that can be made when you have information versus if you have no information. You look at an income statement and it's up and down, you're not matching expenses to revenue. It's really hard to understand what is going on. So harnessing the power of accounting, to in the end have controlled growth and profits. So are you harnessing the power of your accounting, and is what you're doing working to help you achieve your goals? So I just challenge you to implement some of the best practices that I mentioned. Reach out to your accountant or bookkeeper with some questions. Take this video, show them, or reach out to me and my team. We'd love to talk to you about what's going on with your business and any questions you might have. So that's it for today. Today, I just wanted to say a big thank you, for watching this. I hope it brought you some value, and if it did, please let me know. I'd love to hear from you. If you have questions or comments, please comment below. I'd love to hear some feedback from you, and I hope you have a wonderful day. If you are curious and want to connect with me, on my Facebook profile there, just go ahead and click on my website, and there you can schedule a time with me. Love to walk through what you're doing for your business and if there's any way we can help you. Anyways, take care and have a great day. Bye bye.